I am Nicholas Bornodis of Capital Link, and I would like to welcome you all to the 19th Annual Closed-End Funds and Global ETFs Forum. With a 19-year track record, this forum has been established as a major forum that brings together investment professionals to discuss the latest trends and developments in closed-end funds, ETFs, MLPs, and BDCs. And this is a particularly critical year, given that we are going through the pandemic challenges. So we're going to talk about the economy, the investment outlook during this period and afterwards. And we also have the elections coming up soon. So it is a particularly interesting time to discuss what is going on in the economy and the investment world. We have with us a great panel. I would like to thank all the sponsors for being with us today, for supporting the forum year after year. And given that we have, it's a digital event, we have the opportunity to open it up to a larger audience. So without any more delay, I will turn it over to Mariana, who is going to be our moderator. And thank you to Jonathan, Robert, and hopefully Dave Lamb will be with us very soon.
Thank you very much, Nicholas. First of all, I would like to thank Nicholas and the entire Capital Link team for reinventing this conference that we've been attending for almost 2 decades. While we may not see the beautiful flowering trees in the spring, this is wonderful to come back together after so many months and talk about closed-end funds and ETFs. So kudos to Nicholas and the entire team. I know that they've been working extremely hard for a while now. So let's just jump on our very first panel. A very esteemed panelists that I have this morning. And I see that Dave Lamb has joined us as well. Apparently network problems or connection problems, but maybe it was just the selection of his pants. So we'll see, but still thrilled to have Dave Lamb from Nuveen with us, as well as Bob Bush from Calamos and Jonathan Isaac from Eaton Vance. 3 individuals who have been in this, were in this industry for a long time. I know because I've known them for a long time, and who have tremendous insight into closed-end funds that we will discuss now. We will talk about 3 main points. We're going to start with, at the beginning, with closed-end fund IPOs. Then we're going to talk about discounts and premiums that we always need to talk and is always interesting to discuss for closed-end funds. And we're going to finish with some comments on leverage, which has been particularly interesting this year given the volatility. And of course, we hope to still have questions for Q&A. Feel more than free to submit your question in the Q&A section at the bottom. I will be, all of us will be watching those, and we'll try our best to answer all of them for you. So with that, let's just start, as I said at the beginning, with closed-end fund IPOs. And there has been an amazing evolution in the past at least 5 years, if not longer, in structuring closed-end fund IPOs. Jonathan is going to start us with a little bit of history, how that has evolved, and then Dave will tell us about one of the recent Nuveen IPOs. And I know Bob will also give us some insight as well. So Jonathan, why don't you tell us about what has been happening in the past few years, the evolution?
Sure. Thanks, Mariana, and good morning, everyone. Thanks so much for joining this virtual conference. Yeah, I thought I would start this topic just maybe with a little history. It's been almost or near as matters 10 years, since the last financial meltdown, and we've seen a little over 10 years of closed-end fund primary issuance since then. And I thought it might be instructive to kind of see how that has gone, look at what has happened in the last couple of years, which is definitely see a reemergence of closed-end fund IPOs, and kind of maybe compare the developments that have happened since this latest financial shock compared to what happened in 08 and 09. And if you look back to that time, it was really sort of in the middle of 2009 that people sort of started to raise their heads above the trenches and engage again in trying to start primary issuance, which started pretty slowly and really remained that way, I'd say, for a couple of years out of that crisis. But it didn't take that long until the sort of 2012, 2013 era for things really to kind of crank up again. And over that 2-year period, and it was interesting to kind of look back and remind myself, there were 46 funds issued in that 2-year period, and they raised somewhere around $26 billion across those 2 years. In one of them, you were seeing 5 funds being offered in a single month, which is kind of crazy to remember that was going on kind of as recently as 2013. Things then died down a little again, and during the middle part of that decade, around 2015, you saw the first kind of shift in structure to the target term vehicle, which I think one might say became the only kind of acceptable way of offering a closed-end fund IPO in the middle of the decade. These were, I guess, bond-like in nature in that they had a defined maturity date, so the term. They also had a target of returning the initial net asset value, which the fund had been invested in. And they were all pretty short term in nature generally. I think the shortest was probably a 3-year term, the longest maybe 7. And the load structure involved in these was significantly different than the typical perpetual IPO of yore. It had come down to a sort of 2.5% kind of range in nature. And that phase lasted maybe 2 or 3 years till really even that type of issuance began to slow significantly. Part of the problem was there were only really certain asset classes that one could use a target term vehicle with. So I think the market sort of went back, thought about it, and kind of tried to come up with what I can only call as a sort of compromise between the two, which is really where we are today, which is a longer term, typically in the sort of more in the 12-year kind of range, but that does open you up to different kinds of asset classes, as does the fact that you're no longer trying to guarantee or you don't have a stated goal of trying to return the initial net asset value on these funds. And perhaps most significantly, we're going back to a structure that, frankly, I remember from the late 90s, where the closed-end sponsor, so Eaton, Vance, Calamos, Nuveen, are the ones who are responsible for the load that is paid out to the financial advisor, and the investor themselves have no, or it has no impact on them whatsoever. So really, you're talking about a no-load type vehicle where initial net asset value is the same as initial market price, which I think we've seen as we've seen issuance pick up in 2019 and year to date in 2020. I think it's had a definite impact on the market. If I take this year as an example, we lost 2 months completely in April and May, given the sort of recovery from the financial shock. But despite that, have already raised as much as was raised in 2019. So let me pause there, and maybe you can talk a little about someone who's got some real life experience about offering a new IPO in this environment.
Dave, do you want to tell us about your most recent experience that Nuveen just went through?
Sure, Mariana, and I hope you can hear me, and my apologies. One of the experience we have in the virtual environment is technology issues, which your normal device, you have to improvise. So that is one of the challenges we have in this environment, using home technology, and certainly in the environment that we're seeing today in the primary market, the old IPO sales model that involved sales teams getting into as many advisor offices as possible, that model has clearly changed in this environment. The new norm is virtual meetings, including in many cases, daily national webinars, as well as firm-specific webinars. Certainly in this new environment, this virtual environment, there's close coordination with home offices, including scheduling these virtual meetings, which also means understanding different technologies that each firm uses, because you want to make sure that you're accessing advisors in the best way possible. We did, and I think others that have been in this virtual environment have, experienced some efficiencies in reaching more environments. For example, advisors can join webinars from wherever they are at any point in time, and most can use their mobile devices, which we find is a way to have larger, more efficient meetings. We also saw efficiencies from our product teams and investment personnel in that they could join multiple meetings in a single day without having to travel to those offices. So it's very efficient from a meeting perspective, and from the ability that, for example, our product managers could join multiple calls, and they could split the duties, and they could join meetings from their homes and continue to do their day job of managing other assets. So we found that there was some efficiencies in the virtual environment. And quite frankly, Mariana, I think as we come out of this pandemic and we get back to normal, I think some of the efficiencies that we've seen in the virtual roadshows will carry over, where investment personnel, for example, will, instead of jumping on a plane and heading to the East Coast, West Coast, wherever they may go, I think we'll see more and more of a blended model of how we promote funds in the primary market. So I think that's one takeaway from all this. And I know you can say that in across multiple industries, but certainly with the primary market, I think that's something we'll see more and more of, much more efficient use of technology. Again, with the idea of getting in front of as many advisors as possible in that monthly roadshow.
Thank you, Dave. And actually, we already have a question that I think I can very nicely weave into to ask Bob for your input. And that is, most closed-end fund IPOs have been income focused in a great bull market, which is true. Not all of them, but the majority has been, especially a few years ago. Comment on when capital gain participation might be included in the closed-end fund IPO evolution. And Bob, I know your firm has some asset classes that are not just purely income. And after you finish, perhaps, Dave, you can also explain a little bit what you were telling us about your most recent IPO, that while it appears to be a pure pure income focused, it may not be exactly just pure income. So Bob, can you tell us about capital appreciation?
Well, sure, happy to. So I'll take you way back to the 1990s. At that point in time, the closed-end fund space was really primarily two camps. It was emerging market, oftentimes country funds, equity funds that didn't pay a distribution, and you had muni funds. And so the market came to the conclusion that funds that paid a distribution typically traded better relative to their NAVs. And so at that point in time, we sat down with, when I was working at Citigroup or Smith Barney at the time as a banker, we sat down with our clients, which included Eaton, Vance, and Nuveen, and said, well, what can we do about this? And basically what happened was it was a revolution or an evolution in the industry where as a prerequisite, most of the IPOs, and that's the way it is today, had to have some distribution associated with their offering. And so what that did was that opened it up to a whole host of different asset classes, including equities. We at Calamos have a number of funds that invest in convertibles, which actually gives you the benefit of getting some income, but on a risk managed basis, capital appreciation, which then you can monetize as part of the distribution. So this is something I think that's been around for, going back to the 1990s. I think it's always going to be there. I think you're always going to see a blend of income-oriented funds such as the munis, and funds that have capital appreciation involved. There were a number of covered call funds done back in the early 2000s when the equity markets were fairly, they weren't really doing much. It was a way to sort of extract income out of equity by writing options and being able to get some premium income to pay the distribution. So I think over time, the space has evolved. I think it's fascinating now that, and this will be a segue into Dave, that these muni funds now are being offered both as income-oriented vehicles, which they traditionally always had, but also with the opportunity for some capital appreciation. I remember in the day having conversations with my friends at Nuveen, and we were talking about putting funds together that were hybrids, that had some muni in it, maybe some equity. And the idea back then was not well received. Oh no, muni funds are muni funds, and there's taxable and there's tax exempt, and you don't kind of meld them. But obviously markets evolve, and the needs of our clients have evolved, and I think it's great now that you have these different aspects of it. So I guess I'll pass it to Dave, because obviously what you just accomplished with your, and congrats on that fund, certainly resonated with your investors, and certainly I think it offers a different opportunity for the market.
Yeah, thanks, Bob. And I would say, our most recent deal, which was a municipal-based fund that had really a go anywhere type of tilt that could use credit sector yield curve positioning, where the income was not the sole focus of the product, which you have traditionally seen in munis and fixed income. It really was a returns-based approach. And as you mentioned, Bob, the market has evolved really since 2019, when we saw this NAV model. We do see more and more fund sponsors coming to market with products that are more fully utilizing the closed structure, which really means having a stable, more fully invested asset base. It also allows investment managers to potentially more fully express their investment views without having to worry about liquidity needs. So we're seeing more and more products that are more unique and using more opportunities in less liquid investments. For our fund that we just came with, it is a muni-based fund, and a substantial portion of its overall return will be income. But the evolution of the marketplace and closed-end funds, as you mentioned, Bob, being able to monetize that total return, whether it's a total return coming from our municipal portfolio or whether it's an equity or some blend of asset classes, I think also allows shareholders to receive attractive levels of cash flow through a regular distribution. So we are seeing an evolution in our space, and the most recent deals that we've seen really, I guess, since 2019 have included a whole host of different opportunities, from an investment perspective, whether it's private equity or private debt as a sleeve, or direct investments, alternatives, and certainly deeper credit. So we are seeing an evolution, I would say, in the last couple of years of sponsors really trying to look at opportunities for investors to get into more unique, specialized offerings, and really, from the beginning of time, the appeal, I believe, to investors and folks that need regular sources of income or cash flow is the power of the closed-end fund and structure, and able to deliver that no matter what the asset class. And I know you go back a long time. You mentioned country funds. Quite frankly, once upon a time, as you pointed out, those funds didn't even have distributions. But certainly since the late 80s, early 90s, the focus has been on delivering attractive levels of cash flow to shareholders. So it's an interesting time in our business. We also remember once upon a time where in a given year there may be 20 to 30 deals in a year, multiple deals in a month. We're seeing more selective, more focus on one deal a month type of thing. So we'll see, and we're generally seeing in this environment that the deal sizes are tending to grow. There was a period where we had, a little drought where, average deal sizes were relatively small. So I think we're in a new environment today.
And I do remember before the financial crisis reviewing 9 funds for a given month. So even more than what Jonathan mentioned earlier. Dave, you briefly talked about private, and that seems to be a little bit of a trend, at least for some of the funds. And I think that tremendously highlights the benefits of the closed-end fund structure, because what other instrument that is exchange traded can benefit and can have the luxury of investing in private or instruments that are much less liquid without worrying about inflows and outflows or redemptions and creations. So tremendous benefit of and uniqueness of the closed-end fund structure. Let's move to our second topic in terms of talking about specifics on the closed-end fund structure, premiums and discounts. Jonathan, can you give us a sense of what has been happening with premiums and discounts lately? And here I'm going to try to weave in, perhaps for the three of you, another question that we got, and that is about the buyer base. And is it the same financial advisors that we used to have in the past, or perhaps do you see maybe that buyer base expanding into more RIA type clients or anything else? Can you shed some light? Because at the end of the day, I've always thought about this. If we have the entire investor universe focused on closed-end funds, and if they know closed-end funds and understand their risks and their benefits, I think we would have only premiums, to tell you the truth. But it's a very still, I would say, a small base of clients and investors that focus on closed-end funds. So maybe you can talk a little bit about that as we talk about discounts and premiums. But Jonathan, can you tell us?
Yeah, sure. And I think I think what the question sort of ties a little bit into what I was going to say to begin with. No real need for me, I think, to rehash the carnage that went on in all markets back in March. Obviously, what was going on in various asset classes, whether it was equity, credit, municipals, impacted the closed-end fund space as much as it impacted everywhere else. I think the difference here was the size and the speed at which things melted down. On the one hand, in a closed-end fund, that should be an advantage because it's a stable base of capital. But on the other hand, and we'll talk some more about leverage, I think, in a minute, many of these vehicles are levered, and when something like that happens, the impacts can be much more severe than they are when you're not. So that can kind of mess with that stable pool of assets a little bit. But to the question or the additional question you were answering, this is still largely a retail investor base, and as such can be a somewhat inefficient market, which when you go through periods like that can make what is already pretty severe volatility look even worse than it actually is. And there is not typically the sort of institutional buyer on hand to kind of clean that up in an efficient and quick manner. So you will get, and we saw a couple of days, I think, towards the end of March, which were literally just jaw-dropping in terms of the size that the discounts became. I think certainly on one day, I feel like it was more than late 2008, early 2009. And particularly in such things as MLP funds, REIT funds, emerging market debt, and to some extent senior loan funds. But what this inefficiency also means is there's opportunity in those times. And again, I hate to go on about how long certainly the four of us have been involved in this business and how much we have seen, I think, during that involvement. But generally speaking, those are the opportunities that investors want and need to take, as long as they understand the risks that are involved in taking those opportunities, because the market will come back to normal. No one knows exactly what time frame that's going to happen in, but it will, and we have seen both major and minor disconnects occur in all markets, but exaggerated in closed-end fund land, and then have looked back and 6 months later and be like, oh my God, look at that opportunity, and I missed it. And so, you know, do I think the investor base is growing? I think institutions get more involved when disconnects like that happened, and there are probably more institutions realizing that there are opportunities at that time. I'm hoping that just to go back to IPOs for a second, that this new no-load structure is attracting financial advisors that perhaps were not attracted to closed-end funds before, and thus hopefully expanding the investor base if they're bringing their clients into the closed-end fund world. And I'll just finish this bit with just saying, you know, if you look at the overall investment environment today, where else can you buy diversified product offerings that provide the attractive levels of income that closed-end funds provide anywhere? You just can't. So if there were ever an opportunity to introduce people to these vehicles, to me, now is the perfect time.
Yeah, if I may jump in, I think Jonathan's absolutely right. I think you're seeing newer, younger advisors that may not have been around during the financial crisis 10 years ago, that I think that are a little more open-minded when they think in terms of how they can add income to their client's portfolio and investing in closed-end funds with respect to whatever the asset allocation is on their client's portfolio. I'd also say that clearly in February and March, we saw tremendous opportunities in the closed-end fund space, given what how wide these discounts got. But even today, you can really still pick up some phenomenal opportunities. And I'll point to some of our closed-end funds which invest in convertibles. I'll just use that as an example because that's something we know a little bit about at Calamos. But you know, we've had funds that their NAVs are up 25, 35%. Which is more than beaten the related indices such as the high yield or the convertible index, but the stock price is up just a little bit over half of that. And they're trading at discounts, you know, that are double digits, when on average, some of these funds some are even trading at premium. So why is that the case? I think, again, the concern is that many of these investors are a little bit, have apprehension about getting back in the market, in spite of the fact, and then the stock price is just not necessarily caught up with the NAV appreciation, which has been phenomenal. And clearly when you have a bull market, we have seen, at least since the sell-offs in February and March, and you have relatively inexpensive leverage, it's a perfect ingredients for what you're going to see is phenomenal NAV appreciation. But again, the stock price is not quite caught up with it yet. So again, I still think there are great opportunities out there in some of these sectors, especially in the convertible space.
Bob, you talked about some of the newer, younger financial advisors. I would also like to mention some of the wiser, more seasoned financial advisors that were there back in '94, when at least it was the first time that I remember discounts widened tremendously for an entire 94, yeah, for an entire year. And those investors have seen not only that, but 2008 and 2018, and more recently back in March, and a few other less severe kind of dislocations for discounts. And while it may have been scary back in '94, I mean, they've seen this before and they know what happens after. And sometimes you have to just tolerate it. You don't know exactly how long it's going to take, but they've seen this. And I have to say, I feel like, okay, I've seen this before and I know chances are what's going to happen after this. So those are the financial advisors that just have stuck with closed-end funds and are very comfortable with the risks and how they behave. Dave, you wanted to add something?
Yeah, I wanted to mention, Mariana, and to Bob's point, you know, the younger generation of advisors, really, as we see the evolution of how business is conducted, and we're seeing the transformation from transactional fee-based commission-based advisors to a fee-based. That's one area that, I think there's tremendous opportunity and growth in closed-end funds, trying to have those fee-based advisors participate in closed-end funds. Certainly when they're looking at constructing overall portfolios for their clients, and many have an income need, certainly as the younger investors mature, and what we're seeing now, that the growth of folks that are near or in retirement that have income needs, have to replace a paycheck. As we've all discussed, closed-end funds and how they deliver a cash flow and higher levels of income. Jonathan said, where can you find that access to this at a no load? It's hard to find. So I think that's a huge area of growth, getting more fee-based advisors participating in closed-end funds.
I'll bring in here a question that came in terms of what are the main threats to closed-end fund issuance. And I would say closed-end funds in general, because I've heard this, well, with maybe ETFs, or especially with active ETFs, is that going to be cannibalizing closed-end funds? I would say no, because closed-end funds do have a few very specific features, like leverage, which again is a double-edged sword, but it is a very unique feature that closed-end funds have, the discounts as well, and closed-end funds don't need to worry about inopportune inflows or outflows. So I would say active ETFs are not necessarily a threat to closed-end funds.
Yeah, Mariana, I see one of the biggest threats, and you touched upon it, is discounts. You can call it a threat, but Bob just pointed out it's also an opportunity to access an asset class at certain periods of time when sentiment overswings one way or another. In this case, negative, where you can enter at a very attractive level. So I do think discounts tend to pose a threat. They're looked at negatives, but ultimately discounts are embedding investor sentiment at a point in time. And if you want an access and you find a certain asset class attractive, getting it at a discount might be a very compelling way to actually join or participate in a certain asset class that you're trying to participate in.
Okay, we only have less than 5 minutes left. And so in a way, thank goodness that the third topic is leverage. And hopefully, Bob, you can tell us a little bit about leverage and some recent changes. And thank goodness that there is another panel later today that will focus just on leverage. So hopefully we're just kind of getting you a little bit of a trailer, just a little interested in that, and that you will join the leverage panel later today. But Bob, can you give us kind of a 4-minute intro on that, what has been happening?
Sure. So as you pointed out, Mariana, leverage is a double-edged sword. And obviously in a down market, that's going to propel detrimental returns to the NAV. But clearly, as we've seen, as the markets recovered in March, they have absolutely propelled the NAV performance. Because obviously the markets have done well, and the fact that the spread between what you're borrowing at, oftentimes at a floating rate. I mean, our floating rate right now is, I think we're paying 66 basis points, which is phenomenal. You can't beat that. So clearly that has propelled the NAV returns going forward. So it's certainly your friend on the upside. What has happened is, and I'll just reference, so many funds leverage through floating rate, but they also do it through fixed rate, whether it be preferreds or for debt. And I know there's another panel on leverage that's going to get into this a little bit later. But one of the rating agencies, Fitch, has actually come out with new guidelines regarding how they're going to rate the long-term preferred that many of these issuers have embarked on. And in essence, what it's doing is it's saying that they're really not going to put AAA ratings on any preferred going forward. That AA's will only really apply to high quality government, munis, or corporate assets. And that high yield convertibles, equities, preferreds, many of the other asset classes that most closed-end funds invest in are really going to be delegated to the single A platform. So I think that's going to be an interesting change with respect to sort of that dynamic. How that all evolves, I'll let the next panel speculate. But I think it's clearly I think it's worth mentioning at this point in time.
Dave, do you want to just add in the last minute that we have, we've been noticing given the very low cost of borrowing that Bob just mentioned, earnings have been increasing for a number of funds, especially muni funds, and we're already seeing dividend increases. So Jonathan and Dave, do you want to maybe comment a little bit on that?
Yeah, I mean, certainly, as Bob pointed out, the short end of the curve, whether it's taxable or municipal, is at all-time lows. While the long end has come down as well, it hasn't come down to the same degree as the short end. So the steepness of the yield curve or credit spreads is adding incremental earnings to those funds that employ leverage. So that incremental earnings in some cases is being distributed through higher dividend rates. So in munis, for example, Mariana, we've seen several sponsors in the last several months increase distributions, and we'll see what happens. But if you look at the underlying earnings in those funds that are borrowing at historical lows, we're seeing an uptick across the board in earnings.
Thank you, Jonathan. 30 seconds. We're being told that time's up, but anything that you would like to add?
Yeah, I saw the time up, so I'll try and be very quick. Obviously, there's a huge amount of uncertainty about an awful lot out there right now, but the environment that we're in, if you look back historically, is really a kind of perfect environment for closed-end funds, certainly from an interest rate standpoint. So I kind of just repeat what I said earlier on, that if you can get at a discount diversified investment products that offer the type of income streams these funds can, I would suggest you take a look at them.
Great. Thank you very much to the three of you. This was a great conversation. Thank you.
Thank you all.
Thank you.
Thank you, Mariana.